On February 19, 2021, Michael Burry, known for being the first investor to foresee and profit from the subprime mortgage crisis that occurred between 2007 and 2010, tweeted a very concerning message. In that tweet, he said that the American citizens should be prepared for an upcoming inflation that could have serious social consequences.
Cruel summer, record high gas prices at play in these numbers, 8.6% year over year inflation. That is again the highest since 1981.
Is Dr. Burry right? Is the next financial crisis going to be a hyperinflation? Michael Burry based his apocalyptic message on a book named The Dying of Money, published by Jens O. Parson in 2011. In this book, Parson depicts the case of the Great German and American inflations. In other tweets, Burry compared Germany's road to hyperinflation in the 1920s to the current US trajectory. He said that similar to Germany in the 1920s, the US isn't paying for the costs of the pandemic with money raised by taxes but by printing money, which is exactly what Germany did post-war in the 1920s. Other well-respected financial institutions have agreed with Dr. Burry this time. In fact, Goldman Sachs has stated that many investors believe the spending boost will lead to higher inflation and interest rates. Citigroup's chief U.S. equities strategist, Tobias Lefkovich, said that lead indicators suggest that an inflation scare may be in the making. So let's explain why Michael Burry thinks the U.S. is heading to an inflationary hell. Since 2008, the United States government has been printing money through the Federal Reserve System with the hopes of stimulating the economy. The government uses this newly printed money to buy their own government's bonds in the open market. Before going on, let's quickly explain how bonds work with an example. Let's say you're considering buying a bond which has a current price of $90. In the bond conditions, it's stated that in exactly 365 days, you'll receive $100 in return for buying the bond. That's a bit more than 11% yield on your $90 initial investment. If you convince a huge investor to invest hundreds of millions of dollars on this $90 bond, you'll see the bond price go from $90 to $95. Due to this, the bondholder now pays $95 today and gets $100 in 365 days. That's 5% yield, which is less than half the yield provided by the bond when it was valued at $90. The opposite will happen if the bond owners start to massively sell their bonds because they think the issuing government isn't going to pay for whatever reason. So, when the US government buys their own bonds with printed money, the law of supply and demand drives the bond prices up and the bond yields down.
The yield on the 10-year Treasury is the highest in 7 years, and that's freaking out the stock market.
A fundamental principle of bond investing is that bond prices and market interest rates move in opposite directions. Following this principle, as the US bond prices go up due to the increasing demand, US interest rates go down. As interest rates go down, borrowing money gets increasingly cheaper for businesses, which, hopefully, borrow that money to invest it in new business opportunities and create jobs.
The jobs report for January just in, and it shows strong growth, perhaps bolstering President Trump's re-election message heading into the 2020 race.
The thing is that these businesses are run by very clever and sneaky people. They prefer to invest the borrowed money in stable stocks with a yield that's slightly above the interest rates they have to pay to borrow the money in the first place. As businesses borrow money and invest it back in the stock market, the stock prices go up, which is why stock prices are the first ones to get inflated due to the increase in money supply and decreasing interest rates.
A major milestone for the Dow, closing above 28,000 for the first time. New records, too, for the S&P and NASDAQ. Big name stocks like United Technologies, Alphabet, Microsoft, all hitting record levels.
A perfect representation of this situation is shown by the relationship between money supply and gross domestic product, or GDP. In a normal functioning economy, the GDP raises and decreases in line with money supply. However, in America, there's been a growing disparity between the GDP and the money supply since 2008, which shows how the American economy is being manipulated by external forces. This disparity is called inflationary potential, and presents a gap of a bit more than 70% between the GDP and money supply. The opposite to this happens with stimulus checks. This is money that goes straight to the hands of the common American family and is spent on things they need like food and clothes.
The United States government passed more than $3 trillion of stimulus through 2 separate bills in 2020.
This increase in the demand of goods and services will slowly increase the consumer price index that measures changes in the price level of the basket of consumer goods and services purchased by American households. In other words, as opposed to lower interest rates, stimulus checks will actually translate in raising inflation in general prices. This is where Michael Burry's insight comes in. In the context of the inflationary potential previously explained, the stimulus check could ignite a financial crisis where the inflationary potential is realized in less than a year, making the value of the dollar lose up to 70% value. This, of course, could ruin people's lives that have their little savings in dollars. So what should we do if this happens? Well, there's nothing that the average man can do to stop this. There's a big chance the Federal Reserve System will continue printing money due to economical and political reasons. Luckily for us, Dr. Burry also tweeted what assets perform well in an inflationary context, and those are real estate and commodities. We can't know if Michael Burry is right, but what we do know is that all other countries that have drastically increased their money supply in a short period of time ended up facing the consequences sooner or later. Well, that was the video. If you like it, please comment the video and leave a like. That really helps us to get noticed.